Hello everybody, my name is Scott Burkett and I'm a member of the corporate finance team here at BDO in Brisbane. I'm so excited to introduce our speaker today. Dr. Lacy Hunt has so many strings to his bow, but as not to bore you, I will list just a few here that I find particularly interesting. He has a BA, an MBA and a PhD and has been around some of the finest business schools the US has to offer, including Wharton. He served as senior economist for the Federal Reserve Bank of Dallas. In other words, he has seen central banking from the inside. He was chief US economist for the HSBC Group and held other esteemed positions with other global financial institutions. Dr. Hunt has been published in many leading financial publications, including Barron's, the Wall Street Journal, the New York Times, and the Journal of Finance. Most importantly, he is now Executive Vice President of Hoisington Investment Management Company. The firm has over $5 billion under management, pension funds, endowments, insurance companies, and others. I think it's the last point that makes Dr. Hunt someone so worthy of listening to. Unlike many other economists, Dr. Hunt has to eat his own cooking, or has skin in the game, if you will. His decisions in managing duration on US government bonds have real impacts for him and very real world impact consequences for his clients. I'm sure Dr. Hunt feels the gravity of managing money for pension funds where members do not have time to recover from mistakes. I'll finish off with one last bit of personal trivia on Dr. Hunt. He is famous for saying, I'm in the investment business and not the mind-changing business. Ironically, Dr. Hunt has prompted me to do something which is not easy, change my mind. I'm sure everyone will learn something new from his talk today. Welcome, Dr. Hunt.
Thank you very much, Scott. I'd like everybody to look at the title of my speech because it tells you what the speech is about very, very quickly. It says the deleterious effects of massive indebtedness are why MMT has already been tested and failed, and how formal adoption would worsen conditions further. There's 5 major points that I'm going to make today. Is that all of the countries that are relying heavily on debt are experiencing failed policies. In the last 4 quarters, ending March, the US budget deficit equaled a record 19% of GDP, 500 basis points more than at any 4-quarter period during the last World War when there was a full military mobilization. Despite this massive increase in debt, of which fabulous things were promised, the economy faltered badly in the 3rd quarter, with growth only a fraction of what it was in the first half of the year. And this is no different than when we had the debt finance shovel-ready projects of 2009 and 10, or the debt finance tax cuts of 2018. Point number 2, the line of causality. Excessive use of debt triggers the law of diminishing returns, one of the most basic concepts in economics. I'm going to give you the evidence in empirical terms as well as from key peer-reviewed research. A non-linear relationship is at work. Thus, the shortfall in economic growth will become even worse if the path is to ever higher debt levels. Third, another major reason that debt-burdened economies lapse into deterioration is the integration of monetary and fiscal policy. Our system, which worked very well for many years until the past several decades, was founded on the basis that monetary and fiscal policy should be independent of each other. They should be a check so that the mistakes of one of the policy option would not be complemented but be offset by the mistakes of the other branch of policy making. When monetary and fiscal policy are melded together, this increases the government involvement in the economy. It moves the economy further and further into the direction of a command and control economy. As the government takes on more debt and gets cooperation from monetary policy, share of the pie is shifted into the low multiplier sectors, and the share of the pie from the high multiplier sectors declines. And so as we move into a greater and greater command and control economy, the results get worse. And isn't that really what the advocates of MMT want? The main document, MMT and the budget deficit, talks about a return of the people's economy. To me, that's a reference to command and control. This is the exact opposite of the key insight from one of mankind's most brilliant minds, David Hume, writing 2 3/4 centuries ago in the paper Of Federal Credit. And he said that when economies move to ever higher debt levels, that the fiscal credit will control you because you have not controlled it. The fourth point that I'm going to make is that excessive indebtedness acts as a tax on future growth. In fact, it is consistent with what the late economist Hyman Minsky called the concept of Ponzi finance, where the debt being taken on cannot possibly create an income stream to repay the principal and interest. Now, while the instability foreseen by Minsky has not yet occurred, it has resulted in this insidious loss in the standard of living as a result of the ever higher debt levels, which I will demonstrate shortly. Now, while Minsky's thought that the process ends in economic instability, Hume offered an alternative conclusion that is also quite probable. In the same 1752 paper, which I just cited, he said that when a government has mortgaged all of its future revenues, the state, by necessity, lapses into tranquility, languor, and impotence. But either way, governments of large industrial and diversified economies suffer the same consequences of excessive indebtedness that we know to be the case for individuals, households, businesses, municipal governments, and banana republics. Let's now go to page number 2 and look at the first part of the evidence that suggests that massive indebtedness is not working for us. From 1870, when our data series began, until 2000, the growth in real per capita GDP in the United States was 2.2% per annum. Since then, the growth rate has slipped very dramatically. And in fact, it's only been 1.1%. It's fallen dramatically below the trend rate. The trend rate is the blue line in the chart. The black line is the actual trend rate. At the end of 2019, before the pandemic hit, the real per capita GDP was 17% below where it would have been if we had maintained the pre-2000 growth trend. And as a result of the pandemic and all of the debt that we've taken on to try to deal with the pandemic, the per capita GDP in the second quarter of this year was about $58,000, whereas it would have been $73,000 if we had managed to maintain the growth trend. What is happening in the United States is also evident for the global economy. Let's move to the next chart. When economies take on too much debt capital, like any other factor of production, initially economic output rises. But if that same factor of production, such as debt capital, continues to rise, GDP flattens out. And if there's a still further increase in debt capital, then GDP declines. There is a nonlinear relationship. More is not more. It can be less. And the way that we can observe that diminishing returns is taking effect is to look at the marginal revenue product of debt. And what you're looking at the numbers here for the global economy, unfortunately, the data only go back to 2002. But in this brief period of time, we were generating 52 cents of debt globally, and now we're down to 36 cents. Let's go to the next chart. Not only is the global economy experiencing diminishing returns, but we can verify that the economies that are more heavily indebted are underperforming relative to those that are less heavily indebted. Now, here are the marginal revenue products for the US, which is the green line, Europe is the orange line, and Japan is the black line. And notice since 2000, there has been a steady deterioration in the marginal revenue product of the debt, but the United States situation is not as desperate as it is in Europe and Japan. This is the principal reason that explains the diversion in growth, which is occurring on the next chart. What we've done here is we've taken the ratio of real per capita growth in US dollars in 1995, the year in which the Euro area was founded, and Japan relative to the United States. The chart is very startling. In 1995, the United States was actually, the real per capita income was 7% less than Japan. And we were 22% higher than Europe. But as a result of the heavier indebtedness situation in Europe and Japan is now more than 10% below that of the United States, and the European economy is 38% below that of the United States. In other words, we're able to empirically identify the deterioration in growth that has occurred in the United States, and we can also determine that there is a relative deterioration for the economies that are more heavily indebted. Let's go to the next chart. On this page, you're looking at the marginal revenue product of the two major debt series, total debt and non-financial debt. The total debt we can take back to 1870. Notice that there has been a very significant deterioration since the early 1980s. And by 1990, the marginal revenue product of non-financial debt and total debt were setting new all-time lows. In other words, clearly the law of diminishing returns was taking effect. Let's move to the next page. This sort of summarizes the differences, and we can see the steady deterioration in the United States, but we can see the United States holding at an advantage relative to that of Europe and Japan. Now let's look at the next chart. Since 2010, there have been 17 scholarly studies that have identified the deleterious effects of higher debt. And I start with 2010 for a specific reason. Because in 2008 and 2009, there was an early paper by Carmen Reinhardt and Ken Rogoff, in which they made a slight transposition error in one of their Excel spreadsheets. It really wasn't that fundamental, but as a consequence of that error, there was a tendency to throw out the early work of Reinhardt and Rogoff. By looking at the post-2009 period, I'm excluding that earlier paper, which there was the technical error, and looking at research not just from Reinhardt and Rogoff, from others who are not dependent on Reinhardt and Rogoff and who have investigated the issue of the government multiplier and the deleterious effect from other consequences. And on pages that you see in front of you, I've listed the 17 studies. Let's go on to the next page. And by the way, we've discussed all of those in our quarterly letter over the years, and we make that quarterly letter available as a public service on our website, hoisingtonmgd.com. I'm now going to summarize 3 of the studies which I think are particularly relevant to this debate of what would happen if we would move further into the whole of MMT. And I want to draw your attention, first of all, to study number 1 at the top of this page. It was conducted by the two Swedish economists, Berg and Henriksen. I might point out that both of those were Harvard educated. Their finding is, and I quote, a significant negative correlation, quote, between the size of government and economic growth. Specifically, I quote, an increase in government size by 10 percentage points is associated with a 0.5 to 1% lower annual growth rate. This suggests that if spending increases, the government expenditure multiplier will become more negative over time. Let's look at study number 4, which was conducted by economists at the London School of Economics, the University of Pennsylvania, and the University of Maryland. They found that the government spending multiplier is sharply negative in highly indebted economies. The definition of highly indebted is central government debt exceeding 60% of GDP, a condition that is met in most of the major economies of the world. Let's go to the next page. The final study that I wish to cite is labeled number 8 on this page. The writers are Dr. Christina Checharita and Philip Rother. Dr. Checharita is director of the Fiscal Affairs Division of the European Central Bank, and Dr. Rother is chief economist of the European Economic Union. They find that a government debt to GDP ratio above the turning point of 90 to 100% has a deleterious impact on growth. They also find a nonlinear relationship. And I quote, results across all models show a highly statistically significant nonlinear relationship between the debt ratio and per capita GDP for the 12 pooled euro area economies included in their sample. Moreover, confidence intervals for the debt turning point suggest the negative effect on growth of the high debt may start from levels of around 70 to 80%. Incidentally, it was Checharita and Rother's finding of this nonlinear relationship that suggested to me that the law of diminishing returns was at work. Let's move to the next chart. In highly indebted economies, monetary policy becomes asymmetric. If a central bank wishes to tighten conditions, those tools still work. However, when economies become extremely over-indebted, such as most of them are today, monetary policy's capabilities for improving the economy are greatly impaired. And let me illustrate that by the situation in the United States today. Monetary policy has to work through basically 4 channels, the most important of which is the price variable, which you see on the page in front of you, which is the federal funds rate. I draw your attention to the red circles and the blue squares. The red circle is where the federal funds rate is at the start of the recession, and the blue square is the ultimate cyclical low point. Notice that the blue square is always long after the red dot. In fact, the lag time is almost 40 months. But here we sit today with the federal funds rate basically at 0. And the economy is not able to receive the benefit of a declining federal funds rate, which is essential in the early stages of an expansion. Also notice the difference between the blue dot and the red circle. In an early stage expansion, the federal funds rate needs to decline very sharply, in some cases by 200 to 400 basis points. But because of the over-indebted condition, we have come down upon the zero bound, and the central bank does not have the important price mechanism. Let's go to the next chart. Monetary policy must also work through the commercial banks. They're a partner with the Federal Reserve. But in highly indebted economies, the banks are not able to price through the risk premium or the possibility that the loans will default. This is best captured by looking at the loan to deposit ratio using the red and blue format. notice that the loan to deposit ratio tends to decline very substantially well into the expansion by almost 50 months. The loan to deposit ratio is likely to continue declining considering that the debt levels and the risk premium are likely to continue rising. This has important implications that will be clarified shortly. Let's go to the next chart. Another mechanism of monetary policy is what's happening to the money supply. Now, last year, it is true that money supply growth did surge to 20%, which was the highest since World War II. However, that surge is coming around and being reversed as we stand. And if you look at the inset in the lower right-hand corner of the chart, M2 growth is now decelerated to under 8%. The Federal Reserve can have a short-term impact to create money, but this does not mean that the funds, in fact, make their way into the economy on a permanent basis. And the reason for that is the next chart. We have to take into account the velocity of money, which is explained in the equation at the top of this chart. It's from the equation of exchange, which says that GDP equals money times velocity. The great creator of this equation, Irving Fisher, said that when economies become highly over-indebted, the velocity of money falls. And that is exactly what happened. Notice that the velocity peaked in 1997, about the same time that we began to notice this deleterious impact of high debt on economic growth. At that point in time, each dollar of new money was creating $2.20 of GDP, but it is dropped to $1.10. There are very important causal relationships supported by empirical evidence that suggest that the decline in velocity is a result of the over-indebted condition. Let's look at the next chart. In the United States today, the Federal Reserve is able to issue liabilities by unlimited extent. However, these liabilities are not money. For something to be money, it must be a medium of exchange, store of value, and unit of account. Therefore, the monetary base, which the Fed controls by its purchases of government securities, are linked to the money supply by the money multiplier. And notice that the money multiplier has never been stable, but as we become more over-indebted, the money multiplier has dropped from an average of about 8 down to less than 3% today. In my opinion, it will continue to move lower. And even though the Fed now is buying $120 billion of government agency securities a month, the rate of growth in money supply is falling, in part because the money multiplier is dropping, which in my view is related to the over-indebted nature of the economy. Let's move to the next chart. This shows the relationship between the loan-to-deposit ratio and the velocity of money. I indexed both of them to 1 in 1952, which is the first comparable starting point of data. Notice the high correlation in the 90% range. Let's move to the next chart. The other variable that's at work is the marginal revenue product of the debt, also very high correlation. And when we move to the next chart, what we did is we related the velocity of money to an equal weighting of the loan to deposit ratio and the marginal revenue product of the debt, very high correlation. And as the economy has become more heavily over indebted, the MRP has fallen and the loan to deposit ratio pulling the velocity of money lower. And that is exactly what is happening and will continue to happen as long as we remain on the high debt path, rendering monetary policy even more ineffectual in stimulating the economy than it has been. Let's look at the next chart. So the United States is heavily indebted, but it's not as heavily indebted as the rest of the world. Our GDP is performing in a paltry fashion, but we're not doing as poorly as Europe and Japan. In this type of environment, we would expect that the velocity of money in the United States, although it is declining, is doing better than in the other economies that are more heavily indebted. And that's what you see on the chart in front of you. The green line is the M2 velocity in the United States. It's at 1.1 today. Notice the orange line. In Europe today, money is turning over less than 1 time per year. And in Japan and China, money is turning only over about 1/2 time per year. The important point of these set of charts is to show that we can see the deleterious impact of debt in the United States, globally, and in a comparative sense, and in the critical variables of the velocity of money, which renders monetary policy increasingly ineffectual when it wants to stimulate. Let's go to the next chart. This is one of the most important relationships in economics, and it's one that basically the modern monetary school, if you want to call it that, basically ignores. And the critical relationship is shown by the equation in the middle of the upper portion of the chart, which says physical investment I must equal saving out of income. And saving out of income has 3 components: private saving, government saving, and net foreign saving. Notice the dashed line. Since 1929, which is the entire series of data that we have for this series, our net saving as a percent of gross national income was about 2%, which means our physical investment was about 2%. Let's look at the green line, the net national figure. Right now, we're at about 2%. The historic average is at 6%. So our net saving is only 1/3 of what it has historically been, which means that we only can have 2% increase in net national investment, not 6%, which means that due to an insufficiency of saving, we're going to be grinding the economy lower in terms of its ability to grow the standard of living. So the net national saving is at 2. The gray shaded area is your private saving, which rose rather sharply last year. But the government's saving, the red line, was 14%. This is exactly the opposite of what happened during World War II. We ran a deficit of 14%, 15%, but the private saving, the gray shaded area, was 25, 26%, and the green line was up around 12, 15%. In other words, because of the austerity of World War II, we paid off the debt accumulated in the 1920s and 30s, and the economy had a good run of economic growth for a long time. This important relationship between saving and investment indicates that if we move in the direction of ever and ever larger government deficits, what we will move to is just simply no saving to support investment, and the economy will grind to a halt. Let's look at the next chart, which sort of summarizes the problem that we're dealing with. What we have done here is we have compared the government debt to GDP ratio with the 30-year bond yield. Now, one might think that if the government is selling more debt, the interest rate would go up, and that certainly is the short-term effect when the Treasury sells debt. However, notice that a strong inverse relationship has developed. In other words, as the government debt to GDP ratio has moved higher, it's at an all-time high now in terms of gross debt, the government bond yields have gone lower. And the causality here is that the government debt is triggering diminishing returns, making the economy weaker, generally bringing the growth rate down and inflation down, and bringing interest rates lower. And the pattern that we see in the United States is similar to what we see in the other major industrialized countries. Let's look at the last chart. The same relationship for France, Japan, Italy, and the United Kingdom. As the government debt to GDP rises, the interest rates decline. Same causal factors at work, the same result. The concluding point that I want to make is where moving into MMT may ultimately take us. At some point, there will be a recognition by those who advocate a greater command and control economy that taking on more debt is counterproductive. And I'm afraid that there will be an even further expansion of monetary policy into areas where it should not go. When the Federal Reserve Act was established, once we left the gold standard in the 1930s, the Federal Reserve was set up to be the lender of last resort, not the spender of last resort. The Fed can make loans to circumnavigate liquidity crises, but the Fed's liabilities are not legal tender. But now the system is being challenged by those that might like to make the central bank's liabilities medium of exchange. If that happens, the results would become dire. It would trigger an immediate rise in the inflation rate. Gresham's law would take effect. Bad money would chase out good money. It would lead to increased barter. People would be unwilling to hold financial assets. Financial specialization would come to an end. Productivity would be even worse than it currently is, and the whole system would collapse. So here is the path that I see. If we may remain on the high debt path, the growth rate will whimper away. But if we take the experimentation even further and make the central bank's liabilities medium of exchange, then we will end with a bang of hyperinflation. Scott, that concludes my remarks, and I'd now be pleased to answer questions.
Thank you, Dr. Hunt, for that interesting presentation. I might start with, I guess, you know, you're a student of history. I think one of the key things that you sort of discovered early in your career that was that you needed to go back further than data, which was limited to, I guess, the mid 1900s, if you will. So in terms of, I guess, MMT or talking about that as a solution to our current woes, I understand that there has been, you know, periods in the past, you pointed to World War II as one example, but there must be other examples where an economy's been heavily indebted. Can you talk about, I guess, any examples where we've successfully come out of these problems in the past, and has, I guess, the sorts of, I guess, matters proposed by MMT, whether they've been involved in any of those solutions?
Yeah, let's go back to page 8 and 9 for a moment. We put 8 and 9 back up there.
That is just bringing that up now.
And I want you to, let's see, let's look at 9, and I want to draw your attention to the study by McKinsey Global Institute. I can't tell from which number that is. Let's see. Yes, it's number 6. It's number 16. McKinsey is one of our leading students of debt, and they looked at 24 cases of advanced economies that became extremely over-indebted in the time period between 1900 and 2008. They were only advanced economies, no emerging economies. And in all 24 cases, they found, so what they did is they studied the buildup in debt, the debt bubble peak, and then how it was unwound. And they found that in all 24 cases that the debt problem had to be resolved by a period of austerity. And this is how McKinsey defined austerity. They defined it as an increase in net national saving, which I just showed you. I showed you that chart. If you think of it in lay terms, indebtedness is living beyond one's means. And if you are going to correct the indebtedness, you have to live inside your means. Now, here's the problem where we are today. In a lot of these cases, the austerity occurred because it was forced on other countries. Other countries forced it on the over-debtor. For example, the British Empire. And you know what Churchill said about the sun in the British Empire. The British Empire basically dissolved at the end of World War II. The British were very over-indebted. They'd taken on the heaviest portion of the debt to finance World War I. Then they took on debt to try to deal with the Great Depression. And then they had the heavy debt cost for World War II. And at the end of World War II, they were so heavily indebted that the rest of the world wouldn't lend to them. And so what did the British do? Well, they did several things. Well, they could no longer maintain their military operations and hold their empire together. So they had to free people. There were indigenous movements, but they'd always put those down in the path, but they were too weak. And by the way, the British had to continue rationing all the way until 1956. They went through a prolonged, nasty period, but it was imposed on them. In the United States, we had austerity, but it was a fortuitous kind because we were in a world war. We forced rationing on people. We were selling exports. We had military goods, and so people couldn't spend the income that they received, and we were able to pay it down. But in a lot of the other cases, the austerity occurred by what the great MIT economist Charles Kindleberger called letting it burn out. Let me give you an example. In 1873, we had a debt bubble peak from too much railroad debt. The industries that fed the railroad, there was over speculation, over investment. U.S. Grant was president. He had no idea what hit him. We were on the gold standard at the time. There was no central bank. The orthodoxy of the day was that you had to balance the budget. So there was no fiscal policy response of any kind. So the indebtedness was settled by the marketplace. It took 20 years. We had deflation, slight deflation. But eventually we corrected the problem. Well, now think about that. Kindleberger said the other alternative to letting it burn out is heroic efforts. Well, think about Japan. They had a debt bubble peak in 1989, and they tried so many heroic efforts, I lost count. But I think it's over 30, maybe it's over 40. And so think about that. If the Japanese had done nothing in 1989 and the 1873 model in the United States had prevailed, they would be out of their problem. But what are they? They're mired in this debt morass. And so here's the problem. McKinsey says the only way out is austerity. But if you adopt austerity, initially there's a negative impact on economic growth. Modern democracies won't settle for that. And so there's no viable pathway to do what needs to be done. And so we keep trying to solve an indebtedness problem by taking on more debt, the ultimate of which is the MMT solution, which of course would be a grand mistake. And so we're on a path toward an ever slower standard of living, which, as I said earlier, was exactly the condition that Hume saw when he wrote his famous paper in 1752. Great question.
So I guess one other item that people have raised in the past of a way out of this situation by, I guess, technological change. And we've sort of seen examples of that in the past as well, but it feels like things are a bit different with the technological change that we're sort of seeing today relative to the I guess, revolutionary technologies of the past in terms of transportation, sanitation, those sorts of things. Dr. Hunt, can you sort of talk to your views on that a little bit?
Mm-hmm. Well, you're exactly right. Technology's always been important to us. And technology and new discoveries have bailed us out. I think the most important economic research here is from Dr. Robert A. Gordon at Northwestern University. He has a tremendous book called The Rise and Fall of American Economic Growth, and he mentions the factors that you did. what we had from 1870 to 1970 were revolutionary technological changes. The combustion engine, the establishing of the electric grid, transmission of electricity, modern communications, modern sanitation, and pharmaceuticals and chemicals. And that type of technology enhanced the demand for labor and natural resources. But Dr. Gordon says that today's technology is evolutionary. So to build a robot to operate the assembly line doesn't take much more in the way of natural resources, but a lot less in the way of labor resources. And so consequently, the change on the assembly line is dramatic, but it does enhance the demand for the other factors of production. And so the technology is wondrous, it's with us, but it's not the type of technology that was so important in our great era of economic growth. And so even though prominent people like Bill Gates say that the answer to our problem is technology, I think he's failing to make the distinction of your question, the distinction between revolutionary technologies and innovations and more evolutionary. Great question.
I guess coming back to the fact that you, I guess, manage money for a living, Dr. Hunt, I just would be interested in your thoughts as a practitioner. You sort of touched on it a little bit earlier, but it seems as though government policy is playing an increasing part in terms of decisions for allocating capital. And as someone who does allocate capital like yourself, I'd just be curious on your thoughts on that in terms of how different it is to operate in the current environment relative to when you first started your investment process, decades ago.
Well, it was decades ago. I've been in this business 52 years, a long time. Got my PhD in 1969. In those days, the macroeconomic relationships were working in both the short, intermediate run and the long run. Today, because of the heavy involvement of the central banks, the hedge funds, the heuristic trading schemes, the ton of influences that come in and out of the market that didn't come in and out, the instantaneous flow of information, the fundamental economic relationships are not holding over the short and intermediate run, but they still hold over the longer run. And therefore, as a fixed income investor, an investor in treasury securities, I'm forced to take the long view, not the short view. It has been my assessment for a long time that the policies that we're pursuing are undermining our economic growth rate. I mean, you saw it in my very first chart that I gave you. The growth rate was historically 2.2, and now it's only half that. It's 40% down if you stop it at the end of 2019. And so we're grinding lower. The policies may be well-intentioned. They may be politically popular, but that's not the issue. The issue is, what is the impact on people? And so as the rate of growth in the standard of living has come down, one of the most unfortunate aspects is that the dispersion between the high income and modest and moderate income has widened. And this has also adversely affected the demographics. The birth rate in the United States is at an all-time low. We're aging. Fortunately for the United States, our birth rate is better than it is in Europe and Japan and China. And we're not as old as Europe, Japan, and China. But our demographics are deteriorating. So the over-indebtedness is spawning a demographic which is interacting with it, making the problem more and more difficult to solve. And of course, some people say, well, what we need to do then is to greatly increase immigration. Well, that's happening whether we want to or not. It's happening. We're getting massive illegal immigration. The problem is that Professor Friedman said that immigration worked well for us when people came here for economic opportunity. But what's been happening in recent years, they've been coming here for us to support them. Well, so population immigration is picking up, but we have to issue more debt to finance people that are coming here in destitute condition. And so we take on more debt, that pushes us further out the diminishing returns curve. And so what is happening as a result of the over-reliance on governmental policy is that the economy is getting weaker. We're moving further and further into command and control. The government is allocating the credit rather than the private sector. And so the results are getting worse. We're getting more frustrated. And so we're experimenting further and further, but the net result is that we're getting an increasing malallocation of capital.
I guess following on from that then, do you see that, I guess, we're seeing the results of, I guess, a sort of moral hazard playing out where there's an endless supply of liquidity and it's in people's interests to lever up because there's always a central bank or a federal government policy response to save them?
Well, absolutely. There's a presumption. In fact, there was a tremendous study done by Michael Spence and Kevin Walsh. Michael Spence was the Nobel laureate in 2000, former dean of the Stanford School of Business. Kevin Walsh was a member of the Board of Governors. And they looked at the impact of quantitative easing on the allocation of capital. And so what quantitative easing has done is it's given an impression to the corporate managers that the liquidity of financial assets is protected, and that possibly even the price of financial assets are protected. So what do the corporate managers do? They shift more of their resources into financial investment and away from real investment. But financial investment doesn't raise the standard of living. And the same type of mechanism is at work as a result of the declining velocity of money. The Fed increases money, but velocity declines, the liquidity gets trapped in the financial markets. And so the liquidity then causes a bidding up of financial asset prices, bidding down of the returns on financial assets. But it doesn't enhance the factors that produce a rising standard of living. And so the Federal Reserve took these short-term measures, all presumably well-intended, but the net result is that they're accumulating against us. And we can see that another one of the critical aspects of a free markets economy is what the great Joseph Schumpeter, Czech economist who taught at Princeton in the early part of the 20th century, called creative destruction. There has to be success and failure. We reward success and we punish failure. That's been the heart of the moral hazard and creative destruction. And so by making the government more and more involved in this process, we take away moral hazard, we take away creative destruction. And so those are additional aspects of the increased government intervention in the economy that produce these increasingly unsatisfactory results.
So I guess to summarize the themes, it sounds like we've got a problem. There's no easy way out. It sounds like an MMT route creates problems, and it sounds like austerity as a way out is of limited political will. What do you see as the likely, I guess, outcome moving forward, Dr. Hunt? Do you have a view on how you see this playing out to its conclusion?
Well, my view is just to react to it as it occurs. The most frightening thing for me is if as some suggest, including people that are in the running for the new chairman of the Federal Reserve Board, is that we give individuals an account at the Federal Reserve. Well, you change the whole risk equation, and at that point in time, the Fed's liabilities do become medium of exchange, store of value, unit of account. But that, in my opinion, will result in an even worse outcome of hyperinflation. Hyperinflation, everyone's going to be far more miserable in it than they are today. And we do have a lot of cases historically of the countries that have gone down this road, where the central bank's liabilities are made medium of exchange. That's what Germany did at the end of World War I. We know the consequences of that. Many people forget that the Chinese government, in the days of Chiang Kai-shek, that the Chinese central bank's liabilities were made a medium of exchange. And in both cases, the inflation rate shot up. We have cases at the end of World War II in Yugoslavia and Hungary. We've got 2 cases of that in Latin America today, in Venezuela and Argentina. People don't want to hold financial assets, so they forces them to go to barter. Barter didn't really work in the old days, but in the current days where we've got extreme specialization, barter is even more complicated. And so there are people that are thinking that the government is the solution, and so we go to more and more extreme governmental intervention. And so there is a possibility of an inflationary outcome. It's my responsibility to try to deal with each. If you look at some of the great empires of mankind, the Mesopotamian Empire, the Roman Empire, the Bourbon Empire, they became extremely over-indebted. They became so over-indebted that no one would lend to them. Now, we didn't have banks for Mesopotamia and Rome. We had money lenders. We had limited banking institutions when the Bourbons were becoming heavily indebted. And so what their solution was to issue a worthless metallic coin. Well, that would be the historical equivalent of making the central bank's liabilities a medium of exchange. For money to be valuable, for money to work, it has to have value. If you destroy the value of money, then you destroy the monetary system, and you greatly impair productivity. And so the whole nature of the system today is at much greater risk than it ever has been. And this melding of monetary and fiscal policy that was never intended, as I said earlier, moves us further and further in the direction of command and control.
So would that melding that you're talking about be essentially, I guess, running fiscal deficits and then having the central bank purchase those debts in essence to make that possible?
Yeah. But you see, because we were so heavily indebted, the marginal revenue product of debt declines. To meet, Minsky said that if you take on debt that cannot possibly repay principal and interest, you've created Ponzi finance. And so when the marginal revenue product of debt declines, what happens is that it causes the risk premium to rise. You're more heavily indebted, the less likely they're going to be able to repay the loan. The banks, the financial institutions have to price through the risk premium. Right now, I mean, for the banks, the cost of money is very low, and the banks are getting down their non-interest costs, but what is going up? The risk premium. The risk premium is going up because of the over-indebted nature of our situation. And that's difficult for the banks to price it through. And so as a consequence, the Federal Reserve has purchased well over $1 trillion worth of paper since the beginning of the year, comes into the banking system. Holdings of government and agency paper have gone down. The banks can't put it to use. And to protect the federal funds rate from going through the zero bound, the Federal Reserve has to do reverse RPs. So in essence, what we're doing today is the Feds are buying government agency securities, and after the transactions clear, the banks have to hold an overnight deposit at the Fed, earning 10 basis points. Ridiculous situation.
Right. So just to, I guess, talk about one of the counterpoints that proponents of MMT would talk about. So regularly, the case of Zimbabwe or Germany is raised, and there's always a reason why that particular economy, it didn't sort of work. So Zimbabwe being, I guess, the cost of agricultural goods post, people being able to operate farms as effectively as they did in the past, pre-Mugabe. And in the case of Germany, some serious reparation payments to, I guess, what is tantamount to foreign lenders, I suppose, at that point in time.
Okay, well, let's take the case of the Great British Empire.
Yep.
Not there was an issue there. Let's take the Bourbons of France. So the Bourbons of France fought a 7 Years' War. It was in the United States. It was called the French and Indian Wars, but it was the First World War. It was very expensive, and basically the French lost to the English, and they had to give up Canada, or most of Canada, to the British. And then the American Revolution came along, and to get back at the British for having defeated them in the 7 Years' War, they came in and supported the American Revolution. And so the French ended up taking more debt on than the American colonies did. There were more French troops at the Battle of Yorktown, the decisive battle of the American Revolution, than there are colonist troops. And it's the French fleet that blocks the evacuation of the British forces from Yorktown in Virginia. And the French, when they defeat the British at Yorktown, they are the preeminent economy of the world, right? At that point in time, they're more dominant than Great Britain, and then they feel it, and they go ahead heavily overliving, and luxuriant consumption and so forth, and they borrow until they can no longer borrow, and then they issue a worthless metallic coin. So it's a case that we should never forget. And by the way, if you want a more detailed analytical analysis, search for the article by Neil Ferguson, the great Scots economist, taught at Harvard, now at Hoover Institute, called Empires on the Verge of Chaos. And he looks at 4 classic cases of heavily over-indebted economies: Mesopotamia, Rome, Bourbons, and the British Empire. And so conjuring up Zimbabwe or the German economy or even Shanghai Shek, I can tell you, I don't need those historical examples. The U.S. Federal Reserve was designed not to allow the central bank of the United States to be a banana republic. The Fed is not the spender of last resort. You look up the term lender of last resort. In other words, they were given powers to deal with liquidity crises. And so those that are advocating making the Federal Reserve's liabilities medium of exchange will make us a banana republic. It's the nature of the structure. And I personally think that if there are folks that want to move in that direction, there will be a fairly significant battle in the Congress of the United States. At least I hope there will be.
Dr. Hunt, really appreciate your time. Thanks so much for giving us the presentation today and taking on our questions. Really appreciate it.
My pleasure. Nice to be with you, Scott. Thank you for having me.
Thank you. We stop presenting?